Imagine you're holding a winning lottery ticket,
Okay.
and it's worth nearly $1 billion. It's validated, it's printed, it is sitting right there in your hand.
Sounds pretty good so far.
Right. But the moment you walk outside and try to sell a piece of it, the crowd just treats it like a scrap of trash.
Wow.
Yeah, they offer you pennies on the dollar, completely ignoring this massive payout waiting right around the corner.
It's crazy.
It sounds absurd, right? But it is exactly what is happening right now with one of the most critical industrial facilities in the United States. Today, we're looking at Energy Fuels,
Right.
a company sitting on a virtual monopoly and, well, a mountain of cash, yet trading near its 52-week
It's
lows.
a massive contradiction.
Exactly. How does a cash-rich foundational piece of American infrastructure just end up in the bargain bin? Welcome to today's deep dive, where we are going to explore exactly that.
It really is one of those situations that forces you to examine your own assumptions. Yeah.
Oh, absolutely.
You look at the surface financial metrics, and then you look at the underlying structural reality of their assets. And, well, those two data sets are telling wildly divergent stories.
Yeah, Divergent's putting it mildly. Energy Fuels is a company right in the middle of a massive high-stakes transition.
Right.
For this deep dive, we have a really fascinating stack of sources. We're talking fundamental market analyses, technical trading data, and recent insider sentiment reports.
Some really telling data in there.
Yeah, our mission is to figure out the massive disconnect between Energy Fuels' currently depressed stock price and its underlying strategic moves. And beyond just one company, we are going to see what this specific bottleneck reveals about the future of global critical minerals.
It's a big story.
Okay, let's unpack this. To really grasp the opportunity for you listening, we first have to look at why the stock chart looks so incredibly grim.
Yeah, we have to start with the ugly stuff.
Because if you're just glancing at the recent numbers, your instinct is probably to just run the other way.
And understandably so, honestly. The short-term optics are, well, they're undeniably brutal.
Yeah.
If you look at the immediate price action, the stock is currently trading around $11.24.
Right.
That is down 59% from its 52-week high of $27.90.
That is a severe haircut.
It is.
I mean, you don't lose nearly 60% of your value without some serious underlying pressure.
Precisely. And if you look at the multi-week returns, the trend is heavily downward. Like the 13-week return is at a negative 41.57%.
Ouch.
And the 26-week return is sitting at a negative 50.96%. So over the last half year, the valuation has essentially been cut in half.
Just cut right down the middle.
Right. And the pain isn't just in the stock price. It is heavily reflected in their bottom line profitability, which is under immense pressure.
Yeah, the margins.
Exactly. The net margin currently stands at a painful negative 82.7%.
Wow.
That leaves them with a trailing earnings per share of negative 0.3032.
A negative 82.7% net margin. I mean, to put that into perspective for the listener, it's not just a business going through a rough patch.
No, not at all.
It's like looking at a massive battleship that is pulled into dry dock for a refit, and they're essentially tearing the hull apart while still at sea.
That's a great way to look at it.
If you just look at the outside, the plummeting stock chart and that catastrophic negative margin, it looks like a sinking ship.
It really does.
Yeah.
But the margin contraction we're seeing is not because the core legacy business is failing.
Okay.
It is entirely driven by a heavy capital expenditure phase. They are aggressively spending cash to build out their future metallurgical capacity.
Wait, let me push back on that for a second.
Sure.
Companies go through CapEx cycles and upgrade their facilities all the time.
Right.
The market doesn't just slash a company's value by 60% simply because they bought some new equipment or expanded a warehouse,
No, they don't.
So are you saying the broader market is just completely misinterpreting this spending, or is the market seeing a massive flaw in how they're executing this cash burn?
Well, that is exactly the friction point. The market hates uncertainty.
Sure.
And heavy capital expenditure in the mining and processing space is notoriously fraught with cost overruns and delays.
Oh, absolutely.
So the market is looking at that negative 82% margin and just projecting that pain indefinitely into the future.
They think it's a black hole.
Exactly. But what the market is heavily discounting is the foundation underneath that spending.
A balance sheet.
Right. As of March 2026, Energy Fuels is sitting on approximately $0.9 $6 billion in working capital.
Nearly $1 billion in working capital.
Yes.
That is a staggering shock absorber for a company whose stock is getting hammered this hard.
It fundamentally changes the risk profile. Working capital of that magnitude means they have deep, liquid resources to absorb these short-term operating losses. They can fund this massive construction phase without facing an existential liquidity crisis.
So they're not going bankrupt anytime soon.
Exactly. The negative margins reflect the intense cost of physically building new processing circuits, not a lack of fundamental solvency.
Okay, so they have $1 billion acting as a shield. But, cash sitting in a bank doesn't trigger a negative 80% margin.
No, it doesn't.
What exactly are they building that is burning through this capital so violently? And more importantly, what is the strategic payoff that actually justifies it?
They're building a moat, and they're doing it by expanding the White Mesa Mill.
Got the White Mesa Mill.
Yeah. To understand the significance of this, you really have to understand the regulatory and physical reality of this asset.
Walk us through it.
The White Mesa Mill is the only conventional uranium and rare earth processing mill currently operating in the United States.
Wait, the only one?
The only one.
It's essentially a legally enforced monopoly then, just because of how incredibly difficult it is to get the permits for radioactive material processing.
Exactly. The barriers to entry are practically insurmountable for a new competitor. You can't just build one of these things overnight.
Right.
But Energy Fuels isn't just sitting on that legacy uranium business. They are currently undergoing a $104 million CapEx expansion.
That's a big chunk of change.
It is. Specifically targeting what they call the Phase 2 circuit and the Varamata project.
Let's get into the mechanics of that.
Oh,
what does this Phase 2 expansion actually do on the ground?
It introduces a completely game-changing metallurgical capability.
Okay.
They are adding a circuit specifically designed for processing mixed rare earth carbonates, or MREC.
MREC, got it.
This upgrade will allow them to simultaneously produce rare earth oxides, specifically heavy rare earths like terbium and dysprosium, alongside their traditional uranium output, and do it at a commercial scale.
Okay, for you listening, we hear rare earths thrown around a lot in the news.
All the time.
But let's break down why terbium and dysprosium are so critical. If you are building a high-performance electric vehicle motor, you use elements like neodymium to make the magnet incredibly strong.
Right.
But when that motor hits like 15,000 RPMs, it generates intense, blistering heat.
Massive heat.
Yeah. And without dysprosium and terbium mixed into that magnet, the heat causes the magnet to literally lose its magnetic field.
It just melts down, essentially.
Yeah, the motor would just stop working entirely.
Yeah.
You fundamentally cannot build a modern EV, a wind turbine, or an advanced missile guidance system without these specific heavy rare earths.
What's fascinating here is how the metallurgical reality of dual processing completely alters their economic profile.
How so?
Well, in nature, uranium and rare earths often co-occur in the same source, rocks, like monazite sands.
Okay.
Historically, the radioactive uranium was a massive headache. It was a dangerous waste product for rare earth miners.
Just a liability they had to deal with.
Exactly. But because the White Mesa Mill is already fully licensed to handle radiological materials, they can take in this ore, extract the uranium to sell as nuclear fuel, and seamlessly strip out the heavy rare earths.
Oh, wow. So they are turning what is a massive liability for everyone else into a secondary revenue stream.
Precisely. By running both extraction processes through the same facility, they share overhead, licensing, and processing costs.
That's incredibly efficient.
It is. This operational efficiency places the company in a first quartile global cost position, meaning they are producing these critical materials at some of the lowest costs on the entire planet.
And that is the holy grail, right?
Absolutely.
Because historically, the way Chinese competitors have maintained their global monopoly on rare earths isn't just through geology.
Wow.
It's by subsidizing the processing and heavily undercutting Western producers on price just to drive them out of business.
Exactly. By structurally achieving this first quartile cost position through dual processing, Energy Fuels is building an economic moat that is incredibly difficult for international state-sponsored rivals to breach.
They don't need tariffs to survive.
Right. They can compete purely on the math.
Here's where it gets really interesting, though. Even with all this heavy construction dragging down the bottom line, the top-line revenue is actually growing.
Yes, it is.
The data shows their revenue is up 21.95% year over year on a trailing 12-month basis.
That's a strong signal.
Yeah, that tells me this isn't a build it and hope they come scenario,
Yeah.
The macroeconomic demand for critical mineral processing is already pulling them forward.
It is a vital indicator.
Yeah.
I mean, you can have a monopoly, but if no one wants to buy the end product, you just own a very expensive empty building.
Exactly, just a museum.
Right. That top-line revenue expansion proves the market is actively hungry for what they are preparing to offer in even greater quantities.
So they are building a moat against China, they have a domestic monopoly, and their revenue is expanding. But a moat is useless if there's no castle to defend.
True.
Who is actually buying all this domestic supply? This connects their expansion directly to some massive macro drivers. We aren't just talking about a gradual transition to wind turbines anymore.
Not at all. We have entered the era of artificial intelligence. And AI has an absolutely insatiable demand for baseload power.
Let's pause on that word, baseload.
Hmm.
Why is that specifically important for AI?
When a tech company trains a massive new large language model, those data centers run at maximum capacity 24 hours a day, 7 days a week, for months on end.
No breaks.
None. They pull gigawatts of constant power. You simply cannot power that kind of uninterrupted high-density infrastructure with intermittent sources like solar or wind alone.
Because the sun sets.
Right. If a cloud passes over a solar farm or the wind dies down, you can't just throttle down a billion-dollar AI training run.
Right, the data center needs constant, unblinking power.
Exactly. And that realization has driven a massive, frantic pivot by tech giants back toward the broader uranium and nuclear energy space, which provides that zero-carbon baseload power.
Makes sense.
And Energy Fuels, as a primary uranium processor, is perfectly positioned to feed that resurgent nuclear demand, just as the AI supercycle is truly taking off.
And then there is the rare earth side of the equation, which pulls us out of Silicon Valley and straight into Washington, D.C.
Yes, it does.
Now, without taking any political sides here, just looking purely at the policy data from our sources, the current Trump critical minerals strategy is creating a massive structural shift in how these supply chains are valued.
Absolutely.
The analysts are actually calling the current geopolitical setup a $6.5 trillion trap.
The term trap perfectly describes the vulnerability of the United States right now.
How so?
Well, the U.S. has massive economic and strategic ambitions. We're talking roughly $6.5 trillion worth of advanced power grids, defense systems, and tech infrastructure that needs to be built.
That's a lot of infrastructure.
It is. But it fundamentally lacks the domestic supply chain to physically construct it. The raw materials and the processing capabilities to make the magnets for all that infrastructure are overwhelmingly controlled by foreign entities.
So you have a $6.5 trillion vision, but someone else holds the keys to the warehouse.
Precisely. This geopolitical reality heavily favors existing domestic processors like Energy Fuels, who are actively building out capacity on U.S. soil.
Because they're already here.
Right. The government has realized they need this processing infrastructure immediately, and they can no longer rely on fragile international supply chains.
And we can see concrete evidence that the government is panicking to fix this bottleneck.
Yeah.
This might be honestly the most staggering detail in the entire data set.
It's a big one.
The debt for this massive rare earth expansion, that $104 million capex we were discussing, is planned to be covered by a conditional $725 million loan commitment from the U.S. Department of War.
It is highly unusual and incredibly significant.
I mean, the Department of War.
Yeah. The Department of War stepping in highlights that this isn't just an economic issue anymore. It is a matter of urgent national security.
Wow.
Modern defense systems rely entirely on the heavy rare earths that White Mesa will process.
And from a purely financial perspective for the listener, this loan fundamentally protects shareholder value.
It does.
Normally, when a company needs hundreds of millions of dollars to build a factory, they usually have to issue millions of new shares to raise the cash, which dilutes the value of the shares you already own.
A massive dilution, usually.
Right, but this government loan means they can fund the construction without severely diluting the stock, preserving their future free cash flow.
If we connect this to the bigger picture, this completely alters the investment thesis. Energy Fuels is no longer just a volatile mining play trying to scrape by on commodity prices.
What is it then?
It is acting as a government-backed instrument of national strategy, tasked with securing a fully integrated Western supply chain.
Okay, let's look at the board here. They have nearly $1 billion in working capital. They have the only licensed mill in the U.S. Their revenue is growing. They have explosive AI-driven uranium demand, and the Department of War is floating them a massive loan to secure national defense supply chains.
All true.
If I'm listening to this, I'm screaming at my phone, why is the stock trading near its 52-week lows?
It's a fair question.
If the thesis is so bulletproof, why is the broader market so terrified?
Because the market is a weighing machine, and right now it is heavily weighing two massive risks.
Okay, let's hear them.
First, let's look at the mechanical trading data. The company has a high beta, specifically a beta of 1.579.
Let's explain that mechanically for a second. A beta of nearly 1.6 doesn't just mean the stock is volatile, it means it acts like an amplifier for the broader market, right?
Exactly. A beta of 1.0 means the stock moves in tandem with the S&P 500.
Okay.
A beta of 1.579 means if the broader market goes up 1%, the stock jumps about 1.6%.
Great on the way up.
Yes. But crucially, if the market drops, this stock falls much harder and faster. Recently, we have seen sharp, aggressive corrections across the entire uranium sector.
Yeah, it's been a bloodbath.
Because of that high beta, energy fuels got violently whipped downward by the sector's undertow, completely independent of its own internal milestones.
So it's being punished for the neighborhood it lives in, essentially.
Pretty much.
But there is a much bigger internal risk, too, isn't there? We touched on it earlier with the CapEx.
Yes, there is. The execution risk is the absolute elephant in the room.
Right.
Having $1 billion in cash and a brilliant blueprint is one thing. Actually building and successfully operating a highly complex radiological metallurgical facility is entirely different.
That's not easy.
No. They absolutely must execute this heavy rare earth expansion and commission those terbium and dysprosium circuits by the fourth quarter of 2027.
Q4 2027. That is the hard deadline.
It is.
And let's be real about what happens if they miss it. If they run into engineering failures or, supply chain bottlenecks for the construction materials, they just continue burning through that billion-dollar cushion while generating zero new revenue from the rare earths.
Exactly.
That negative 82% margin becomes a black hole.
Exactly. The broader market looks at the history of mining expansions, sees that Q4 2027 deadline, and essentially says, we'll believe it when we see it. We are not paying a premium for a factory that isn't fully operational yet.
I get that. The market is notoriously impatient and highly skeptical of massive construction projects.
Always.
So the algorithms and the institutional funds are just waiting on the sidelines. But what about the insiders? What do the people actually sitting in the boardrooms reviewing the engineering schematics and managing the cash think about this execution risk?
This is where the data gets incredibly compelling. The insider signal over the last 90 days points to what we call cluster buying.
Meaning multiple different executives or directors buying shares independently at the exact same time.
Yes. We are seeing 4 distinct open market buys from insiders, accumulating a net total of 95,730 shares.
That's substantial.
And the most critical part of that metric, there have been 0 sell transactions in that same period.
Nearly 100,000 shares bought, 0 sold. That is a loud signal.
Very loud.
I mean, executives might sell stock for a dozen reasons: buying a house, paying taxes, diversifying, but they only buy on the open market with their own money for one reason. They believe the price is going up.
It results in a perfect insider sentiment score of 100.
Wow.
Yeah. When management is aggressively buying while the stock is languishing near 52-week lows, it strongly indicates they believe the broader market is drastically overstating the execution risk.
They think the market is just wrong.
Exactly, and that the stock is fundamentally mispriced.
And we are seeing that exhaustion in the broader trading volume, too. Data shows the current 10-day average volume is sitting at just 0.65 times the 3-month average.
The trading volume has significantly dried up.
Let's break down why that matters mechanically. When a stock price gets crushed, but the volume of shares being traded also drops off a cliff, it means the selling pressure is exhausted.
Right.
The weak hands, the people who are going to panic sell because of the sector downturn, they've already left the building.
They're gone.
The only people left holding the stock are the long-term believers and, well, the insiders who are actively scooping up the remaining cheap shares from anyone willing to part with them.
Technical analysts refer to this specific setup as a high-conviction accumulation zone.
Interesting.
It's also worth noting that the longer-term 52-week return is still positive at 25.85%.
Oh, really?
Yeah. This suggests that despite the violent recent correction, the overarching structural uptrend of the company remains fully intact.
Okay, so if the sellers are exhausted and insiders are accumulating shares for a multi-year hold, what specific milestones should you, the listener, be watching for to see if this massive gamble actually pays off? We know Q4 2027 is the deadline for commissioning the mill, but is there a catalyst before that?
Yes, there is a critical gating event much sooner. We're looking toward the final investment decision, or FID, for the Donald Joint Venture Project in Australia, which is anticipated in the third quarter of 2026.
Q3 2026. But wait, why is a joint venture in Australia the key to unlocking a processing mill in Utah? Why drag dirt across the Pacific Ocean?
Because processing capacity is entirely useless without high-quality feedstock.
Ah, of course.
The Donald Project in Australia is a massive deposit of mineral sands, specifically rich in monazite, which contains exactly the heavy rare earths the White Mesa Mill is being upgraded to process.
I see.
Mining the dirt and processing the dirt are two entirely different bottlenecks.
So the Australian mine is essentially the pipeline?
Exactly. A positive final investment decision on that joint venture fundamentally locks in the raw material required to run the expanded American mill at maximum capacity for decades.
It secures the future.
Yes, it seamlessly connects the mine to the magnet. Securing that FID effectively de-risks the entire supply chain for the White Mesa expansion.
So if they hit that FID milestone in Q3 2026 and then successfully commission the mill in Q4 2027, what is the ultimate financial prize here? What does this company look like on the other side of this transition?
The math on the other side is just staggering.
Okay.
Based on management's base case feasibility study for the Phase 2 expansion, the project points to a combined net present value of $3.7 billion.
Let's translate that metric for a second. Net present value, or NPV, basically means if you take all the future massive cash flows this mill will generate over its entire life, and you discount them back to today's dollars to account for time and risk. Well, project alone is worth $3.7 billion today.
Okay, exactly.
That completely dwarfs their current depressed market cap.
It does. And in terms of pure cash generation, once the facility is fully operational, it has the ability to generate approximately $765 million in EBITDA. That's earnings before interest, taxes, depreciation, and amortization per year. Per year over its first 15 years of operation.
$765 million in earnings a year. Compare that to the reality right now, where they are running an 82% negative net margin just to build the thing.
Right, it's a completely different company.
It is a night and day transformation of the underlying business.
This raises an important question. Has the market fundamentally mispriced energy fuels?
It sure looks like it.
The algorithms and short-term traders are pricing it right now as a struggling uranium miner caught in a sector downturn, punishing it for heavy capex spending.
But that's just the surface.
Exactly. The structural fundamentals suggest it is rapidly transitioning into a highly profitable, government-backed, mine-to-magnet powerhouse. The massive gap between those two realities is where the entire investment thesis lives.
It is the ultimate test of patience, really.
It is.
The short-term pain is completely obscuring the long-term structural value. So let's pull all of this together. We started by looking at a financial profile that looked like a total disaster, down nearly 60% from its highs, bleeding cash on the bottom line, and getting dragged down by a highly volatile sector.
Yep.
But when you look past the construction scaffolding and understand the mechanics of what they are actually doing, the narrative flips entirely.
Completely.
You have a company cushioned by nearly $1 billion in working capital. You have the only licensed conventional uranium and rare earth mill in the U.S.
A true monopoly.
Exactly. Leveraging a brilliant dual processing metallurgy to achieve global first quartile costs. You have a massive conditional loan from the Department of War protecting shareholders from dilution because, well, this is a matter of national security.
Can't ignore that part.
No. And you have insiders aggressively buying up shares while the broader market exhausts its selling pressure.
The structural pieces are undeniably in place for a transformative, multi-year hold, provided they can execute on their engineering targets and hit those key milestones in 2026 and 2027.
So what does this all mean? It means that for those willing to look past the current 52-week lows and understand the mechanics of the transition, the long-term structural uptrend remains fiercely intact for this critical minerals play.
Well said.
It is a story of irreplaceable infrastructure, domestic monopoly, and massive geopolitical necessity. Which leaves us with one final thought to mull over.
What's that?
Right now, global superpowers are racing for dominance in artificial intelligence and next-generation energy. Trillions of dollars are being poured into software code, complex algorithms, and massive glass and steel data centers.
True.
But the true winners of this era might not be the famous tech giants in Silicon Valley writing the software.
They need the hardware.
Exactly. The true winners might just be the obscure, heavily guarded processing mills turning raw, radioactive dirt into the physical magnets and baseload power sources that make the entire digital world possible.
It's a fascinating perspective.
It makes you wonder what other unglamorous, completely unnoticed bottlenecks are hiding in plain sight in the global supply chain, just waiting to become tomorrow's monopoly.